Welcome everybody. On behalf of Whipley Financial Advisors and our Retirement Plan Services team, I would like to welcome you to our 401k enrollment presentation. Many people seem to worry about their future financial outlook, but one concern outweighs all the rest, and that is retirement. With Social Security's future unknown and pension plans being a thing of the past, nearly half of all retirement income is expected to come from a 401k plan. People often say that they will never be able to retire. Unfortunately, the reality is that many people that never plan to retire are forced to, whether it's due to their own health or the need to care for a loved one. Whatever the case may be, making an effort to contribute to your retirement plan early can help make retirement a reality for you. So how can you start on the path to achieving your long-term retirement goals? Well, there are two main factors to consider. First, start saving as early as you possibly can. And second, maintain discipline with a long-term investment strategy. Now let's look at a hypothetical example. We have two investors, Investor A and Investor B. They both are the same age and they save until they are age 65. In this hypothetical example, we crafted a plan where the assumed rate of return is an average annual 8%, and participants contribute $80 every 2 weeks. Investor A contributes $3,000 to their savings per year for roughly 10 years, starting at age 30 up to age 39. Investor B, on the other hand, waits until they are 40 years old to start contributing. At that point, they contribute $3,000 to their retirement savings each year for 25 years until they reach the age of 65. All in all, Investor B spends an extra $48,000 in contributions. Plus, they end up with $103,000 less than Investor A at retirement. Starting at an earlier age of 30, Investor A has significantly more time for their dollars to compound. Now let's consider the concept of a long-term investment approach. Investor C begins investing $3,000 per year in a broadly diversified portfolio at age 30 and continues until they reach age 65. Whereas Investor D invests $3,000 a year, all in cash, starting at 30 and continuing until they also reach 65. Due to differing investment styles, Investor C ends up with nearly $500,000 more than Investor D at retirement. Investor D's decision to remain in cash erodes their buying power and forgoes vast growth opportunities. Of course, these examples are purely hypothetical and do not factor income taxes that will be assessed on distributions, as well as many other factors, but they go to illustrate how waiting to save and investing in a long-term, globally diversified portfolio can impact the long term. Next, let's dive into the concept of time value of money and the power of compounding. Putting away even the smallest amount each paycheck can add up to pretty substantial savings once you account for how money can grow over long periods of time. In this hypothetical example, the participant contributes $80 to his or her retirement savings every 2 weeks. Assuming the average annual rate of return of 8%, you can really see how the time value of money works, especially after 20 or 30 years. The longer you put your money to work for you, the longer it has to grow, which can translate into more savings for your retirement. So now you know the importance of saving early, and you also know the importance of a long-term investment approach. The next question might be, how should I invest my retirement savings? Well, we like to rely on two main factors: asset allocation and time. For many, money is a very emotional thing. When the market is doing well, people tend to exude more confidence, which generally motivates them to buy at the top of the market when prices are at their highest. Conversely, when the markets are down, people tend to get nervous and sell out at the worst possible times. When the market is down, this could be the best time to buy. By staying disciplined and deferring the same amount into your retirement plan at regular intervals, you hopefully take the emotions out of the equation. This is a disciplined way to buy low and sell high. Whether the market is going up or down, you will stay invested no matter what. Here we look at the impact of missing the 10 best days in the market over a 20-year time horizon. When people buy and sell at the wrong times, letting their emotions guide them, their returns can suffer. Diving a bit deeper, this chart shows the performance of a $10,000 investment between January of 2001 and December of 2020. The 10 best days of the market are listed in the gray boxes: 5 in 2008, 2 in 2009, and 3 in 2020. Riding the waves of market volatility while maintaining a fully invested portfolio, results in assets of $42,231. However, letting emotions guide investment decisions results in assets of $19,347. Maintaining discipline results in more than double the returns. Before we move on, there's something very interesting and important to note. Out of the 10 best days in the market, out of 20 years, thousands and thousands of days, what do those 10 best days have in common? They directly follow periods of market downturn, or extreme market downturn. Investors tend to get nervous during this market downturn, and that's when they sell out, missing these 10 best days, cutting their returns in half. So don't let emotions guide those investment decisions. Markets are very resilient. Selecting your investment strategy for your 401k account can be confusing, so we've simplified it into 3 different options. You'll be able to choose from a target date fund, a pre-built model portfolio, or, if you'd prefer, a build-your-own investment portfolio. Target date funds are meant to make long-term investing simple. By selecting a future retirement date, your investments automatically become more conservative as the retirement date approaches. This option may be best suited for participants that wish to set and forget their investment choice. For the second option, we have developed 4 risk-based asset allocation models to suit a variety of time horizons and goals. Each model portfolio is globally diversified and automatically rebalanced on a quarterly basis. This option may better suit those who would like a little more control of their investment allocation, but want to leverage a disciplined investment approach that is based on asset allocation and the investor's objectives. Our final option, and instead of choosing a pre-allocated investment option, you may also elect to create your own custom portfolio by allocating your planned contributions among the individual funds composed in the model portfolios. Participants with prior investing experience or those already working with an investment advisor might choose this option. If you'd like to take this route, please don't hesitate to contact your advisory team for help navigating the fund selection process and understanding the differences between these funds' investment allocations, expenses, and more. To continue, every year the IRS establishes contribution limits for the 401k plans and also tax credits. If you are actively contributing into a 401k plan, definitely talk to your advisor about both. Contributions include traditional before tax and Roth contributions. There are also catch-up contributions available to those aged 50 and older. Voluntary contributions to your 401k plan allow tax credits or $2,000 for single filers and $4,000 for married joint filers. Eligibility requirements include adjusted gross income, age, student status, and tax filing status. Employee contributions can be traditional, Roth, or a combination of both. The 2 main factors that go into choosing one over the other are age and tax bracket. Traditional contributions are pre-tax. The earnings are then tax deferred, and the withdrawals in retirement are fully taxable. On the other hand, Roth contributions are after tax. Earnings grow completely tax-free, and withdrawals are non-taxable in retirement. There can also be advantages in contributing to both. Having a bucket of both pre-tax and Roth to pull from in retirement provides flexibility and diversification from a tax perspective. For example, people pull from a Roth bucket to avoid an increase in tax bracket during their high spending years in retirement. If a large expense comes along, like paying for a family member's wedding or a fancy car, etc., it will be great to have Roth as an option. Also, nobody knows what tax brackets might look like decades from now. If they are much higher, it will be nice to have Roth dollars that are tax-free. If they are much lower, it will be nice to have a traditional account to take advantage of those low brackets. So what makes a 401k special? There are other ways to save for retirement, right? A 401k is special because the employer can contribute on your behalf. Depending on your plan's provisions, your employer can match contributions up to a certain amount, contribute additional dollars at the employer's discretion, or allow employees to share a percent of the company's profits. All employer contributions are required to be made on a pre-tax basis and may be subject to a vesting schedule. Vesting is a fancy term for ownership. If you spend enough time with your company, the dollars they contribute on your behalf are yours to take with you should you leave. One of the most popular questions we get as advisors is how much should I put away each year for retirement? We would recommend saving 10 to 15% of your gross income annually, and that includes employee contributions and your employer contributions. With that being said, we understand some people can't reasonably afford to put away that much, but saving just a little bit each year is so much better than saving nothing. The next step is electing your beneficiaries. These are the individuals who will receive the assets of your account if you happen to pass away. You must elect at least one primary beneficiary, and if you're married, you must designate your spouse as the primary. However, if your spouse signs a waiver, another individual can be chosen. It is also important to add contingent or secondary beneficiaries. It is common to add children, siblings, or other close relatives, but the choice is yours. Now I'd like to talk about rollovers. Rollovers involve transferring funds from one account to another, and are extremely popular when starting a new job. Eligible rollover accounts include 401k, 403b, profit-sharing accounts, defined benefit plans, SEPs, Simples, and traditional IRAs. However, a Roth IRA cannot be rolled over into a 401k. The three main considerations when rolling into a plan are fees, investment fund lineup, and consolidation of retirement accounts. Consult with your plan advisor for any additional questions surrounding rollovers into your plan. In order to create a good base for your retirement plan savings, you have to decide how much will you contribute, will your contributions be traditional, Roth, or split, which investment portfolio is right for you, and who will you designate as your beneficiaries. To access your online account, navigate to wipfli401k.savetoretire.com. Hit the New User button and enter the plan password that was found in your enrollment kit. Complete the credential fields and continue on to the enrollment process. If you have any questions, please don't hesitate to reach out to any member of the Wipfli Financial Advisory team or email us at rps@wipflifinancial.com. Wherever you are in your retirement journey, I hope this presentation was a little bit helpful. Thank you. Have a good rest of your day.